2023. Oil prices would be cut by nearly half from their peak last year, and that interest rates would be down into the mid threes from 4.25 at their peak last year in terms of the long-term treasury yield. I would have told you that growth stocks would have had a wonderful end to the year. And of course, that did not happen. It did not happen because it seems as though investors are waiting for permission from the Fed. So let's go through, as we usually do, fiscal policy, monetary policy, economic indicators, market indicators and signals, and then spend a little more than normal time on innovation. Not what is to come, but what happened last year in terms of breakthroughs in innovation, truly disruptive innovation. And it seems like the market's ignoring those as well. The next national election, roughly 2 years from now. So the good news there is there probably will not be profligate spending, which from our point of view ultimately turns into one kind of tax or another, either outright taxes or inflation, which is a cruel tax, or debt, which is a tax on future generations. So that's the good news. Even better news would be bipartisanship. It's hard to believe it's possible. We are hearing more members of Congress, that is, talking about their desire for bipartisanship. So hopefully steps in the right direction. As I described, inflation can come in many forms. And as I'll describe later, we do not believe that it is going to cause inflation going forward. After all, it's called the Inflation Reduction Act. We don't believe that either, but we do believe that inflation is coming down for other reasons. One of the things that happened in the last 3 months was the COLA adjustment, the cost of living adjustment for Social Security. Or it was within the last 6 months. And that was 8.7%. It's based on the CPI. That many people are pointing to as a possible inflation or possibly aggravating inflation. Well, the COLA for Social Security is for retirees. They tend not to be big spenders. It does provide them for some relief from the food and energy price inflation that we've seen. At least this is uncharted territory. And in fact, the last time we saw meaningful declines in the money supply was in the Great Depression, which was, of course, a very deflationary period. So it's very interesting to hear the Larry Summers of the world hearkening back to the 70s in terms of expectations for inflation. He's ignoring a lot of real-time indicators. If you look at the average money supply growth for the last 25 years and the last 50 years, a very long time, the average money growth has been 7% at a compound annual rate. So, zero negative is a huge departure. And we believe highly deflationary. And we're beginning to see that as I will illustrate as we get into the market indicators. The Fed funds rate went to 4.5% in December, and it does appear that the Fed is determined to take it up again. They want nothing to do with a legacy associated with inflation. And as we've suspected for some time, they are unanimous because there are people like Larry Summers out there saying, you're going to be responsible for another run at 70s style inflation, which was highly destructive. And many times I've mentioned here that the 70s inflation is nothing like the inflation we just experienced. The 70s inflation started in the mid-60s with the Vietnam War, with the Great Society programs, one after another, and then we went off the gold exchange standard and lost all discipline. That's nothing like what we've been through. We have been through a massive supply shock, and we do believe this year we're going to drop below 2%. And in fact, the bond market believes it. The bond market's break-even rate is 2% for the next 10 years. In other words, the bond market is expecting 2% inflation for 10 years. And this is the Fed's goal. The bond market thinks we are already there. And in fact, we believe the bond market will continue to rally, meaning long-term interest rates coming down relative to short-term interest rates, inverting the yield curve. Right now, we're at 70 basis points, a little more than that. And it is interesting now to watch the bond market disengage somewhat from the Fed's rhetoric. The stock market has not done that yet. In fact, the stock market is behaving like the Fed is right. The energy sector is reaching for all-time highs, even though oil prices peaked in 2008. One other thing to note about monetary policy, it's very influenced these days by Keynesian economics and something called the Phillips curve. Phillips curve basically suggests that if employment is strong, then that will lead to inflation. The history of the last 40 years, however, is the opposite. Employment was pretty strong when you adjust out for recessions, pretty strong for the last 40 years. And yet inflation and interest rates came down quite a bit from mid-teens in the early 80s to 0.5% during COVID. So the history of the last 40 years does not support the Phillips curve. And yet it is interesting to listen to the Fed say, wow, employment, we got to get it down. Otherwise, wages are just going to take off and become embedded in the system. That was the 70s experience, but it has not been the experience since then. And we do not believe. For those who think the economy is booming, the unemployment rate dropped from 3.7%, which was revised to 3.6, to 3.5. So back to the cycle lows. Non-farm payroll employment looked stronger than expected. I think 223,200 was expected, but previous months were revised down. So that was interesting.
In fact, I think according to the Bank of America recent surveys of fund managers and advisors, it's probably the advisors, we haven't seen this amount of cash on the sidelines since I think it was 2006, maybe even 2001. I do know also the same survey shows that the put to call ratio in the U.S. market, meaning those short relative to those long put calls, is at 1.5 now, and it has not been that high since 2001. So we have an incredible amount of fear in the market.